The DOJ reportedly looking to break up Google as a potential remedy after their antitrust win against the tech giant. Our Deirdre Bosa is talking about the risks to Google and maybe to investors in today's Tech Check. Morning, Dee.
Hey, good morning, Carl. So a breakup is one of several remedies the DOJ is seeking. Remember, though, that Alphabet is going to appeal the decision. This could be years in the making. But as we saw with Microsoft in the 90s and early 2000s, simply the threat of a breakup, that can be enough to hurt innovation in the long term. Time, money, talent in that case. They went towards legal defense and compliance instead of new products. The company was more cautious in its business strategies. The stock, Microsoft, essentially went nowhere for a decade. But there's sort of a new view that has emerged in recent years as the mega caps get bigger and they diversify into new businesses, especially higher margin ones like cloud computing and advertising. Some investors no longer see a breakup as necessarily a bad thing. Jefferies this morning looked at the enterprise value of Alphabet's different units, concluded that the market is seemingly assigning no value to Google's cloud and hardware businesses. A breakup then could unlock value as the argument goes. Longer term, though, breaking up Google's ecosystem could be damaging, especially in the age of AI, where data is the gold. The more of it, the better. The more integrated, the better. The company has the largest collection of data in the world. It has devices, chips, cloud computing, AI models, and an AI assistant. At yesterday's Made by Google event, we didn't even get the new Pixel phones until 25 minutes into the keynote. It was all about integration, the ecosystem, the full stack, as executives said many, many times throughout the presentation. So while Microsoft wasn't ultimately broken up in the 2000s, there is another example that I wanted to look at, and that's another tech giant that recently went that way, kind of on its own accord. That would be e-commerce giant Alibaba. Under pressure from Chinese regulators, it announced in March of 23 that it would split up into smaller, more nimble, more valuable companies. Investors, they rejoiced and they looked forward to IPOs and new fundraising. None of that, though, has happened. Baba shares are actually lower since that announcement. So it's interesting to think about the implications back when Microsoft was under pressure and just how big these tech giants have grown and how integrated they have become and how essential that is in the age of AI.